Imagine that you request your 401k rollover, and a few days later, a check shows up at your house for a few $100,000, maybe a few million. That can be really scary, and a lot of people are left wondering, what do I do now? Do I sign this check, or am I sitting out of the markets in cash? And how do I know I'm not paying taxes? That's what we'll talk about in this video. We're not going to get as much into whether or not you should do a rollover, although we'll touch on that. This is more about what to expect and some FAQs, and hopefully that makes the whole process smoother for you. By the way, I'm Justin, and I've done dozens of 401k rollovers with clients in the 20 plus years that I've been an advisor. Before we get into the logistics, let's just make sure that it's going to be the right thing to do to move that money from a 401k somewhere else. I've got an entire video on that, so we're not going to get into deep detail, but briefly as a refresher, you've got a couple of options of what to do with your money when you leave your job. One of them is just to leave that money with the employer in the current 401k plan. That'll give you some time to evaluate the decision, and as long as you have more than $7,000 in there, you're often okay. Next, you could roll the money over to an IRA, which is what most people end up doing, although not necessarily right away. You could also move the money to your new job's 401k if you have one and if they have a plan, and if the 401k is any good. And of course, you could cash out and just take a distribution, but that does mean you're going to be paying taxes on the entire amount. And if you're not ready to do that, it's often not the best idea. A lot of people ask, my investments have been doing really well, so shouldn't I just keep it where it is? Over the years, I've earned X percent or something. And what I would say is maybe, but usually that has more to do with the investments you chose that you're currently using than with the vendor themselves. So you can probably get very similar investments in an IRA or in a different 401k. So I wouldn't give too much credit to the 401k provider based on how you're doing. You want to evaluate what are the fees, what are the other options, and compare those to all the alternatives. We're going to assume that you want to roll the money out, and let's just triple check here that there's nothing interesting that could get in the way. This is an article on my website. There are a few more pros and cons to consider, but before you leave, you just want to make sure that you're not going to something with significantly higher fees, at least not without any benefit. You want to remember that if you are between the age of 55 and 59 and a half, you might be able to use that rule of 55. So consider waiting until 59 and a half. Predator protection can also be another one. Check your state laws to see if you're significantly better off. There might be some nice stable value offerings. These are typically safe investments that pay a rate of interest inside of 401k plans that you can't quite replicate outside of a 401k, like in your IRA. You might be able to put off RMDs for better or worse. And then if you do have company stock in your plan, that might also be worth looking into. Does it make sense to use an NUA strategy, net unrealized appreciation? But there are certainly benefits to moving out to an IRA as well. Sometimes you get lower costs. You have a lot more control over things. It's just a lot of pros and cons that you need to evaluate. Now, if you are going to move forward, then the next thing is to make sure that the rollover is set up the right way, because some specific wording can help you avoid problems. When you're requesting your rollover, let's say you're doing it with a paper form or on an online form, you're clicking the buttons, maybe you're talking to a customer service rep on the phone. Often what you want to ask for is a direct rollover. That's typically a direct rollover to an IRA or maybe to another retirement plan if you're going to your new 401k. So look for that checkbox or use that exact language with the customer service rep, direct rollover. With a direct rollover, they're going to make the check payable. And yes, it is still often a check, even in the modern world. Don't ask me why. They're going to make that check payable to the new IRA custodian or to your new 401k plan. So you don't want it made out to you personally. The way it will typically appear is it'll say payable to, let's say, Charles Schwab, FBO, your name. FBO means for the benefit of your name. And so that's how you know it was made out to your new IRA provider. That's Charles Schwab in this example. But it is also your money and tied to you. There are also indirect rollovers. That's where they do indeed make the check payable to you. So it's payable to you personally. You would be the person who negotiates the check and you can cash it out. But if you're doing a rollover, the idea is you're going to put that money back in to a retirement account like an IRA, 401k, 403b, etc. That's not something people do often, but maybe you have your reasons for doing it. Keep in mind with an indirect rollover, if they make the check payable to you, they're typically going to withhold, they have to withhold 20% of what's called mandatory tax withholding. So you'll only get 80% of your account balance. If you had 100,000 in there, you're going to get 80,000. The other 20% goes straight to the IRS for tax withholding. It's a deposit on what you might owe. So you might get some of that back as a refund. You might owe more. It just depends. But the thing is, you don't get it all. And if you want to do a rollover, then you need to come up with that 20% somehow and then add it to whatever you're putting into your next retirement account. You can also do an in-house rollover, an internal transfer sometimes. So if the place that has your 401k also offers IRAs, then sometimes they'll just move your assets right from the 401k into an IRA. That's typically pretty quick and smooth because they want to keep the money. Not always your best choice, but sometimes it's a really handy trick, and we'll talk more about that in a couple minutes. Now, I mentioned that you often get a check, and don't know if I made you scared, because sometimes if the check is payable to you, then yes, there was probably mandatory tax withholding. It's probably treated as a distribution unless you roll it back in using presumably a 60-day rollover, which can be tricky, so you really want to research that. But if you get a check that's payable to, again, Charles Schwab or Fidelity, FBOU, or your company 401k plan, FBO, your name, then in that case, it's generally okay. Just because you got a check doesn't mean it's a taxable distribution. If they processed it correctly, and that FBO language is a good sign that they did, then you're typically not going to owe taxes or have to deal with weird stuff on your tax return. You will get a tax form, a 1099-R, and that will report that you took the money out, but it should be coded correctly if they did it correctly, noting that it is not taxable to you for this year. Let's talk more about those checks because these can cause a lot of anxiety and some questions you have to answer as you go through the process. One of them is going to be, should it go to your home address or should it go to the new place? And in some cases, you don't have any choice. The 401k provider is going to say it has to go to your home address, and then you deal with it later. And if that happens, that's okay. You will just forward the check to your IRA provider. Let's say it's Charles Schwab or Fidelity, or to your new 401k. And you can also walk it into a branch. If you've got a Schwab or a Fidelity branch in your area, you can take it right there, and that cuts the transit time down. But if you have the choice, then which is better? And there are pros and cons. On the one hand, if they send it straight to the new provider, then that again cuts the transit time because it doesn't have to come to you and then you forward it. But sometimes you just have a little more anxiety. You're not in control of the check. Did they put the account number on it right? Did they use the right address? What seems to happen, don't ask me why. I've been doing this for 20 plus years, but look, I've never seen a check get lost, a 401k rollover. I've never seen one get lost, but they do seem to move through the mail slower. I don't know why that is, but everybody's on edge. We're all watching for that check, wanting to make sure that it's going to get to the right place, and that can cause some anxiety. Fortunately, there is a solution to that we can talk about in a minute. The other option is to have them send it to you. Again, you can walk it into a branch, or you can, put some notes on it to make sure that they have your account number right and it goes to the right address. Sort of a personal choice there. If it does come to you, then I would do a couple things. Well, no matter what you're doing, if you're sending it to the new provider or to yourself, they'll often ask, do you want to pay a little bit of extra for FedEx or UPS? And I generally recommend that, especially if the amount of money is anything meaningful. First of all, it's going to move it faster. More importantly, it is tracked, so you know exactly what is going on with that check and when it reached its destination. That can help you figure out if it's time to worry yet or not. There is a little cost, 25 or 40 bucks or something, but assuming you're not changing jobs every other week, that's a pretty small price to pay for keeping track of your life savings. Now, what do you do if you receive a check? I would suggest taking a picture and making a copy of it. Then you, again, forward it or deposit it at a branch. There's also the question that always comes up. People want to know, do I sign the check? Do I have to endorse the check? And the answer is generally no if you're doing that direct rollover. So If it's payable to Fidelity or Schwab, FBOU, it's not payable to you, so you can't negotiate the check anyway. Your signature wouldn't do anything. And what if that check actually does get lost? It can certainly happen. In that case, it's usually not a complete disaster, but it can be problematic, especially if the markets happen to be going up while you're waiting on all of this to get sorted out. But I would say it's very hard for somebody to steal that money from you. I'm not going to say it's impossible, but it is very difficult. They have to do a number of illegal things and get away with fraud at some pretty sophisticated financial institutions, opening accounts in your name and then getting that money back out and doing it quickly is often not easy. But again, I can't promise it's impossible. What's most likely to happen if the check, got burned or destroyed or something like that, what's most likely to happen is that they would then reissue the check. But you may need to wait a while, because if you can't produce that check and say, I'm giving you the other one, I want you to reissue a new one for whatever reason. If you can't produce that check, they may need some time to make sure that it's okay to cut a new check. All right, that's probably enough on this ancient technology of checks. Let's talk now about some of the tax implication. If you have multiple money types in your 401k, you're generally going to have multiple payments coming out, so multiple checks. That might be one for your pre-tax account balance, and that's often going to be a combination of your own pre-tax contributions and pre-tax employer contributions. Then a separate check for the Roth type money. And then if you have after-tax money, that might be another payment. So your traditional pre-tax money generally goes into a traditional / rollover IRA. So you're getting these multiple checks, right? Then you might get the Roth type money, and you would generally put that into your Roth IRA. You can potentially do a Roth conversion by taking that pre-tax money and just distributing it to a Roth. I don't really see that. I mean, typically people are going to go from IRA to IRA. I mean, do you know if you want to convert exactly the amount you're going to get in that check? That's often not the case, but it may be possible. You can look into that if you want. I'm not suggesting it at all. And if you have that after-tax money, again, this is not Roth after tax. This is voluntary after tax, or it might be some other designation. That can go into a Roth IRA in many cases. So be sure to check and see if that's an option for you. What you probably don't want to do, maybe there are some exceptions to this, so I won't say always. What you probably don't want to do is take that voluntary after-tax money and put it into a pre-tax IRA, because then you would be paying taxes on it twice. Now let's talk about the investments. So again, when you do a rollover, in many cases, I would say most, they're going to sell everything you have, basically cash you out so that they can create a check. There are some cases where the money can move in kind, meaning the shares, without being sold, can move from the 401k, let's say, into an IRA. You can always ask about that, but it's not the norm. That means that your money is often out of the markets. It's on the sidelines, sitting in cash, not gaining or losing value or earning anything, because what happens is you submit your request to roll over. They would sell everything you have. Then the next day, they typically issue a check. Then there's transit time for that check to get to wherever it's going. Maybe you use FedEx and overnight it. Maybe you use regular mail, but there's transit time there. If it comes to you, then you have to get it and deal with it and then take it somewhere else. Maybe you mail it or walk it into a branch. That's more transit time. And all of that is great if the market is going down. But if markets are rising, then you may be a little unhappy. You have to remember the markets could go either way, up or down. And as long as you're not doing this often, it may not make a big dent in your retirement. But if being out of the market bothers you, there are a couple of solutions. One of them is you can ask if multiple distributions are allowed. So instead of taking everything out in one chunk and moving it over, you could take it in a couple of different chunks. And that way, hopefully, one of the times it's up, the other time it's down, and the other time it's flat. Who knows? Or you can do a two-step rollover, which helps to eliminate that all-at-once feeling. To do that, you would open an IRA with the same vendor that has your 401k. Let's say your 401k is at Fidelity. In that case, you would open a Fidelity IRA. I'm not suggesting for or against Fidelity, by the way, but they're generally not too bad. You would open that Fidelity IRA, ask them to move the money into it, which they will very gladly do. It's probably what they're going to suggest first and prominently to you. So you'd open up that Fidelity IRA and maybe buy some investments. So you're out of the market very briefly, if at all, because it's just an internal transfer. We don't have all that transit time, and the processing can go faster because it's all internal to Fidelity. Then you're reinvested. Let's say you own some ETFs. You've got the actual shares of the ETF, so you're back in the market and it's going up, C, down, Z, or whatever the market is doing. Then, if you wanted to have your IRA somewhere else, let's say a Schwab, for example, you could then request a transfer of those shares in kind from your Fidelity IRA to the Schwab IRA. What ultimately ends up happening is you are then invested during that transfer period going from Fidelity to Schwab, as opposed to if Fidelity cut you a check, mailed it, and then you had to get it into Schwab. There might be some time when you're out of the market. So it's a two-step process. First is open the internal IRA, make the transfer there, and then do an in-kind transfer to your final destination. Another thing I want to make sure and mention is that your IRAs are different from your 401k. With your 401k, you enroll, you pick your investment mix. Every time money goes in, it automatically goes into those investments. And with IRAs, that is not the case often. You typically need to make a trade to buy or have some other sort of automation going on to get the money invested. And what happens a lot of times is people end up putting money into an IRA, then they forget to invest that money. They assume it's just like the 401k where it just automatically gets invested into your investment mix, a portfolio. But again, with IRAs, you often need to make every single trade yourself. So the risk there is just letting your money sit in cash, sometimes for years or longer, if you didn't understand how that works. Not that cash is necessarily bad, but we want you to have it when you intend to have it, not just when you ended up accidentally having it. So I hope you found that helpful. If you did, please leave a quick thumbs up. Check out my website, maybe send me an email, and I look forward to talking with you soon.